My journey as a trader started in a pretty unexpected way. I was a teenager, home from school with the flu, and my dad brought me a stack of books from the library. One of them was called Liar's Poker by Michael Lewis, the same guy who wrote The Big Short. The book was meant to be a warning about the greed and craziness of Wall Street in the 1980s. But for me, it had the exact opposite effect. I was completely hooked. Reading about life on a trading floor, the big personalities, the high stakes, it was like a lightning bolt. I went from being a typical kid, obsessed with skateboarding and football, to someone with a laser-sharp focus. I knew, right then and there, that trading was my calling. This book wasn't just a story. It was a wake-up call that completely changed the direction of my life. I already had a low-level job at a pension fund, but after reading that book, I knew it wasn't where I was meant to end up. I started applying to universities all over Europe. I got accepted to a university in Britain, but there was a huge problem. I couldn't afford it. There was no funding, no family help. I had to pay my own way. So, I started working like a madman. During the day, I was at the pension fund. In the evenings, I'd skate 5 miles to an amusement park and work there until 1 in the morning. I devoured the finance pages, read English books to improve my language skills, and just absorbed everything I could. My family wasn't exactly supportive at first. On the day I left for the UK, I had to get myself to the airport alone. But over the years, they came around. My sister even told me she chewed her nails to the bone the first time she saw me on TV. She was so nervous I'd freeze up. It's funny looking back. There's a saying in the markets, don't confuse talent with luck. My first real taste of speculation was pure, dumb luck. It was September 1992. I had just been accepted to university and had saved up every penny I could for tuition and living expenses, but I was still a little short. As I was packing up my life in Denmark to move to the UK, a massive storm was brewing in the currency markets. At the time, the British pound was part of something called the European Exchange Rate Mechanism, or ERM. Basically, it was a system to keep European currencies stable against each other. But the UK was in a recession, and speculators, like the famous George Soros, were betting heavily that the pound was overvalued and would have to drop. On a day that would become known as Black Wednesday, the British government was forced to pull the pound out of the ERM. The value of the pound plummeted. I, a 22-year-old kid who knew nothing about this, just happened to walk into my local bank in Denmark right at that moment to exchange my Danish kroner for British pounds. Just a few days earlier, I would have gotten about 12 kroner for every pound. Because of this massive currency crash, I walked out with an exchange rate of around 9 kroner to the pound. That single lucky transaction instantly made me an extra 4,000 pounds. My entire annual budget, including tuition, was only 2,500 pounds. I had accidentally stumbled into a historic market event, and it made my entire university education debt-free. George Soros made $1 billion that day. I made enough to secure my future. But I wasn't the only one who saw value dislocations back then. I heard a legendary story when I started working in London. It was about an Englishman who owned a printing company. He was on holiday in Paris, standing near the Eiffel Tower, and he bought a hot dog. He was so shocked by the price, he thought the vendor was ripping him off. To check, he bought another hot dog from a different stand. Same price. This experience sparked an idea. He went into a Parisian supermarket and started writing down the prices of everyday items. Back in London, he compared them to the prices in his local store and concluded that the French franc was massively overvalued. He called his broker, who later became my boss, and with a 5,000-pound deposit, he started betting against the franc. He relentlessly pursued this one single idea and turned that 5 grand into 8 million pounds. It's an incredible story, right? But here's the kicker, and this is the most important part. He later lost all of it, and then some. This is the lesson that 99% of people miss. Winning is one thing, but what happens in your brain, asterisk after asterisk, you win can be your biggest enemy. That surge of confidence, if left unchecked, will destroy your decision-making. Keeping the money is just as important as making it. My university education was heavy on economic theory. It taught me how markets are supposed to work. All these elegant models where everyone acts rationally. But it didn't teach me how to trade in the real world. I felt something was missing. The idea that you could understand a complex system by assuming people are always logical just didn't sit right with me. I mean, look at us. Humans are driven by fear, greed, and 100 other emotions. We're anything but rational, especially under stress. I found myself drawn more to economic history than to economic models. Reading about events like the rich man's panic of 1907 was a turning point. A famous speculator, Bernard Baruch, made a fortune by understanding the sequence of events. A group tried to corner a stock, it failed. And he correctly predicted they'd have to sell other stocks to cover their losses, causing a market crash. He wasn't just looking at numbers. He was anticipating human behavior and the chain reaction of panic. That's when it clicked for me. The markets are all about perception, sprinkled with a bit of economic reality. My job isn't to be an expert on a virus or a new technology. My job is to understand what the other players in the market are feeling. Are they scared? Are they greedy? Right now, as I'm recording this, the market is dropping because of fears about a new virus. I'm not shorting the market because I'm an epidemiologist. I'm shorting it because I can see the fear and I'm positioning myself based on that sentiment. The key is to read the emotions of the crowd while keeping your own emotions in check. This is what this channel is all about. It's about learning to think differently from the 99%. It's about having the mental flexibility that no textbook can teach you. It's knowing, like the Kenny Rogers song says, when to hold M and when to fold M. So, am I a gambler? Well, if that means I make calculated decisions in an uncertain environment, then yes. But I do it not because I have a special gift, but because I've spent years learning to control my own emotional responses to winning and losing. You can be a good person and still be a successful trader. You just need to learn to master your own mind. After I graduated, I didn't land my dream job as a trader right away. But I got a great job at Chase Manhattan Bank, which later became JP Morgan Chase. It was an invaluable experience. I was working with portfolio analysis, which meant I got to watch the markets unfold every single day on a Bloomberg terminal. I fell in love with that machine. Sneak into the office on weekends just to devour trading stories, study charts, and download data. Working for a top American bank taught me a work ethic and gave me a front row seat to the greatest show on earth, the financial markets. That's where my real education began. Have you ever wondered what it takes to actually succeed in trading? I mean, really succeed? Not just get lucky once or twice? Many people think it's about being a genius, having some secret indicator, or access to special tools. But what if I told you the secret isn't a secret at all? It's something much harder to find: an unbreakable work ethic. When I started my career at JP Morgan, we were allowed to work as much overtime as we wanted, and I took full advantage of it. For nearly 3 years, I never had a month with less than 40 hours of overtime. I wasn't the smartest guy in the room, but I was determined to outwork everyone. Success wasn't due to immense intelligence. It was built on sheer hours and forensic attention to detail. I made a sacrifice for what I wanted. It reminds me of the Navy SEALs ethos. Anything in life worth doing is worth overdoing. Moderation is for cowards. My dream was to work on a trading floor, and when I finally walked onto one, it was a special experience. But it was also a culture shock. The atmosphere is electric. When it's busy, it's a melting pot of raw human emotion. I've seen a colleague kick his PC so hard it had to be replaced. We've seen a private trader get a $10 million margin call at 6 a.m. and wire the funds by 7 a.m. It's a world where you become immune to the money-changing hands. It all just becomes numbers on a screen. You witness everything: impulse buying, panic selling, greed, stubbornness, despair, and pure exhilaration, all in quick succession. It doesn't look like a finely tuned global economic machine. It looks more like a chaotic local market stall with everyone shouting to be heard. After working as a broker for years at firms like City Index, I must have witnessed tens of millions of trades from thousands of different people. And you know what? Very few stood out for the right reasons. For every incredible success story, I can tell you 10 horror stories. I recently asked a friend of mine, CEO of a trading company in London with 30 years of experience, about the great traders he's seen. His answer was shocking. He said, "I wish I could tell you. I have seen many people make a lot of money, but very few manage to keep it." He explained that even seasoned hedge fund managers often traded their personal accounts with a shocking lack of discipline, a complete contrast to how they managed client money. So, why do so many people fail? It's a pattern he sees over and over again. Most clients actually have more winning trades than losing ones. You'd think that makes them good traders, right? Wrong. The problem is, they lose much more on their losing trades than they make on their winners. For every pound they win, they lose about £1.66. Now, you might think brokers love this, but the truth is, they want you to win. My CEO friend was very clear on this. He said, "We wish our clients would trade better. We do absolutely everything we can to help them. They provide sophisticated charting packages, news services, analytical tools, tight spreads, everything you could possibly need." They'd be green with envy back in my day. When I started 20 years ago, the spread on the DAX was 6 to 8 points. Today, it's under 1 point, and yet, it makes almost no difference. Most people still fail. Why? The CEO outlined 5 key warning signs they see all the time. 1. Starting with too small an account, like under £100. 2. Overtrading, jumping between anything and everything that moves. 3. Holding on to losing trades for far too long while cutting winning trades short. 4. Adding money to losing positions instead of winners. And 5. Trading without a stop-loss. He said people who do these things will, with near certainty, lose their money. As brokers, they see this self-sabotage happen constantly. If you look at any broker's website in Europe, they are legally required to post their failure rates. For the biggest, most well-known brokers in the world, the numbers are staggering. 74%, 75%, 77%. Even up to 89% of retail clients lose money. These statistics don't lie. This brings us to a hard truth. In trading, being normal means you are statistically destined to lose. The average person with their normal patterns of thought and behavior will follow the same path as everyone else and end up losing their account. So, if you want to succeed, you cannot be normal. Normal is not good enough. The industry's focus is all wrong. Trading shows, magazines, online courses, they all focus on the how-to. How to scalp. How to day trade. How to use this indicator or that chart pattern. But if everyone has access to these tools and techniques, and 75% are still failing, then clearly the tools are not the answer. Think about this. Traders are often taking advice and training from people who work at brokerages but do trade themselves. It's like people who take the bus to work giving financial advice to people who arrive by helicopter. To achieve the success you know is possible, you have to stop thinking the path to riches is about finding a magic strategy or tool. Yes, you need a plan. Yes, you need to understand the markets. But the real change needs to happen somewhere else entirely. It's not about what you use. It's about who you are and how you think. It's about breaking away from the normal patterns that lead to failure. It's about cultivating the mindset and discipline of the few who actually make it. The tools are just the beginning. The real work starts within you. Have you ever noticed that all the trading advice out there sounds the same? Trade shows, magazines, brokers. They're all pushing the same solutions. They tell you it's all about finding the perfect strategy, the magical indicator, the secret technique. But if that were true, why do over 90% of traders lose money? It's a staggering failure rate. If you do what everyone else is doing, you're almost guaranteed to get the same result as everyone else. And that result, for most people, is failure. This might sound harsh, but being normal in the trading world just won't cut it. A while back, I was invited to speak at a trade show in London. I could talk about anything. So, I decided to talk about this exact issue, the disastrous failure rate in trading. My argument is simple. If 90% of CFD accounts lose money, and we assume the people opening these accounts are normal, intelligent individuals, then the problem isn't the market. The problem is human. There must be something fundamentally wrong with how normal people think and act when it comes to trading. It's a paradox, really. Trading has never been easier or cheaper. The technology is incredible, the spreads are razor thin, the margins are favorable, and the tools are everywhere. Stock indices are hitting all-time highs, meaning there's plenty of movement to trade. So it should be easier than ever to make money, right? But it isn't. People are still struggling. So what's the deal? Why isn't it working? The core of the problem is this: what does normal trading behavior look like? And more importantly, how can you avoid it? If you think like everyone else, you'll get the results everyone else gets. So let's break down what normal is. Normal is getting stuck in a never-ending cycle of education, always hunting for the next new edge. You read a book, take a weekend course, learn about candlesticks, RSI MACD, moving averages. The list is endless. You get excited. You feel like you've found the secret. I remember when I first started. I read Liar's Poker and knew I wanted to be a trader. I was told the key was to buy low and sell high. Sounds simple, right? Except every time I bought low, the price just kept going lower. It's terrible advice, yet it's the kind of thing we all listen to when we begin. With advice like that, it's a miracle only 90% lose. It should be 100%. Even the so-called Bible of technical analysis. Technical Analysis of Stock Trends by Edwards and McGee won't turn you into a pro. It's a must-read, for sure, but reading it won't make you Rafa Nadal on the tennis court. What's interesting is that the real genius behind that book was a man named Richard Schabacker. He codified almost everything we know about technical analysis, but he died young, and his brother-in-law, Edwards, rewrote his work. So, Edwards and McGee got the credit. But here's the classic mistake newcomers make after reading books like that. They look at an indicator like RSI or stochastics and excitedly declare a market, overbought or oversold. But what do those words even mean? Overbought is just an emotional term for expensive. The indicator manipulates data to make you think the market is too high and should be shorted. Oversold does the opposite, tricking your mind into thinking something is cheap and a good value. I saw this just the other day. It was a huge down day for the Dow Jones Index. I was short all day and having one of my best days. Near the end of the session, a student of mine messages me. He says, "Tom, have you seen the stochastics? It's deep in oversold territory. Is it a good idea to buy now?" I told him, I'm short. Maybe you should ask someone else. He was shocked. A little later, he tells me he bought the Dow. Think about that. On a day when the market has fallen 400 points, with 10 minutes left before the close, he decides to buy. Why? He thought because it had fallen so much, it must be cheap. He was hoping for a last-minute bounce. I used to think exactly like that, back when I wasn't profitable. Of course, the Dow didn't rally into the close. There was no bounce. I wasn't worried about the money he lost on that one trade. I was worried about his way of thinking. That's the real problem. If trading were a school, it would be shut down. Can you imagine a university where 90% of students fail their exams? Would never happen. We're all intelligent, hardworking people. Normally, when you work hard at something, you see at least some success. But not in trading. The problem is that 99% of people don't know how to lose. When you lose, the emotions you feel, fear, frustration, regret, cause you to act against your own best interests. Think about it. An elite soldier is terrified the first time they're in combat. That's why they train in simulations over and over. They use repetition and breathing to habituate their minds, to calm their emotional responses. A free solo climber doesn't let fear take over when they reach thousands of feet up without a rope. They've spent years conditioning their minds. This is what's missing from most traders' education. For every hour you spend on technical analysis, you need to spend at least 15 minutes on what I call internal analysis. You need to know your weaknesses, your strengths, what you're good at, and what you're not. If 99% of people lose money, and 99% of people think the key is just analysis and strategies, then you can be 100% sure that analysis and strategies are not the key. Let me share a brilliant piece of research with you. An analyst named David Rodriguez at a major FX broker wanted to figure out why so many clients lost money. He looked at 43 million trades from about 25,000 clients over 15 months. It's a massive, statistically significant sample. He looked at one simple thing: the number of winning trades versus losing trades. Take a guess. What percentage of those 43 million trades do you think were profitable? Most were in major pairs, like the euro-dollar, where the spread is tiny. So that should help, right? The answer is shocking. 62% of all trades were winners. More than 6 out of every 10 trades made money. A trader with that kind of hit rate should be profitable. But they weren't. And therein lies the problem. It's about how much you win when you're right, and critically, how much you lose when you're wrong. The 90% of losing traders get this part completely backward. They win small and lose big. Changing this isn't about finding a better indicator. It's about breaking free from normal and becoming the exception. What if I told you that being right most of the time could actually make you a losing trader? It sounds crazy, right? But I've seen it happen. I once analyzed a trading system that had a fantastic hit rate, winning way more often than it lost. You'd think that's the holy grail. But when I dug into the numbers, a huge problem surfaced. When they won, they made about 43 pips. But when they lost around 78 pips. So even though they were right more often, their losses were so much bigger than their wins that it wiped out all their progress. There's nothing inherently wrong with losing more on a single trade than you win. But it means your win rate has to be incredibly high to stay profitable. It's a tough game to play. Now, let me flip this on its head. A colleague of mine, a professional hedge fund trader from South Africa, has a win rate of only about 25%. From a traditional perspective, that sounds terrible, but here's the secret. When his fund loses, they lose a set amount. Let's call it 1x. But when they win, they can win as much as to 5x. It's easy to see why he's massively profitable, even though he's wrong 75% of the time. This completely shatters the common wisdom you hear in the trading industry. This brings me to something that really grinds my gears: the whole risk-to-reward ratio concept. Now, the idea itself is innocent enough. But the way most traders apply it on a trade-by-trade basis is, in my opinion, deeply flawed. In my live Telegram group, I always call out a stop loss for every trade. Always. But inevitably, someone will ask, "What's your target?" My answer is usually a bit sarcastic. Something like, "Sorry, my crystal ball is out for repairs." I know. It's not very polite, especially after the 450th time I've been asked. But there's a real reason I don't set targets. How on earth can I possibly know what my reward will be? I literally have no idea. Even if I tried to guess using some fancy calculation, I know my own strategy. I like to add to winning positions. If a trade hits some arbitrary target I set, my philosophy is not to close it. I would absolutely kick myself if I closed a trade for a nice profit, only to watch it rocket even further without me. I would much rather give back some of my open profits for the chance to capture a much larger move. It's a trade-off. I can even count the number of times V had a 100-point winner in the Dow that eventually reversed and turned into a break-even trade. Just a week ago, it happened again, and it was all documented. Some people in my trading room were not happy. They asked why I didn't just take the profit. It's hard to explain, but it all comes down to which pain hurts less. For me, the pain of missing out on a massive trend-following move is far greater than the pain of giving back a 100-point gain. It's because of this mindset that I'm sometimes able to catch those huge 400 or 500-point days. You have to choose one philosophy or the other. I don't believe you can have the best of both worlds. A few years ago, I did an interview with CNN, and they asked me about the traits that separate winning traders from losing traders. This was based on my experience watching millions of trades from retail clients while working on a brokerage trading floor. One identified a few key differences. The first major mistake is trying to find the absolute low. When a market is in a downtrend, whether it's for the day or over several weeks, there's this powerful urge among retail traders to pick the bottom. Maybe it's the desire to buy cheap, or maybe they're using the wrong tools. I'm not sure. But I do know that this habit is incredibly damaging to a trading account. Winning traders, on the other hand, tend to trust the prevailing trend. It seems like a small mental shift, but it's everything. The losing trader repeatedly fights the trend because it feels emotionally satisfying to buy something that seems cheap, like getting a discount at the supermarket. But the financial markets aren't a supermarket. There is no cheap. There is no expensive. There is only the current price. The winning trader understands this. They aren't emotionally attached to the idea of a bargain. They focus on the here and now, see the trend, and join it without any internal conflict. The second mistake is the mirror image of the first, trying to find the high. When a market is trending up, so many traders want to find the perfect spot to sell short. Again, it's that distorted view of cheap versus expensive. They see a market that has risen significantly and think, this has to be the top. So they try to fade the move, placing bets against the rising price. But just like with finding the low, this is a recipe for disaster. And this leads to the third common and very costly mistake, thinking every small countermove is the start of a new trend. I've lived through some of the darkest days in the financial markets from a trading floor. I remember September 15, 2008, the day Lehman Brothers went bankrupt. The Dow fell 4.5%. Throughout that day, there were a couple of attempts to rally. Both failed miserably. And it was tragic to watch our position monitors. With every single green candle that appeared on the 5-minute chart, we saw a flood of buy orders from clients. It was like they were possessed by the idea that the low was just around the corner, and they had to be the one to catch it. The low didn't come that day, or the next. This is such a common trait. Traders see one little pullback against the main trend, and they reconvinced it as a major reversal. Let me tell you, more fortunes have been lost trying to catch falling knives than you can possibly imagine. It seems so obvious that newcomers and even some experienced traders believe that trading success is all about analyzing charts. But this belief is a huge detriment to their accounts because no one ever told them that focusing all your energy on charts is a mistaken strategy. It's the psychology, the discipline, and the understanding of market dynamics that truly matter. Thanks for watching, and if you found this helpful, make sure to subscribe for more insights.